My goal today in the next couple minutes just to reinforce some of the key things that John said from the standpoint of what we see as an intermediary. Remember, in the process, we're typically requesting from our client, the business owner, and their accounting team financial information, and then we want to be able to present that in the best light to prospective buyers. So we're going to talk a little bit about some of the financial information presentation tips, how we're going to package financial information depending if we're pursuing a financial buyer or a strategic buyer, and it helped to validate why strategic buyers often can pay a lot more for your business than a financial buyer. I do want to touch on a couple more items around the quality of capital assets and how that impacts valuation. The concept of paying for the past, buying for the future, key issues that revolve around that. Most of the time, valuation is based on past performance. The purchase decision to move forward is because of what they can do with your business. So how your financial information is presented and issues that come up around that area will be discussed. And then common misunderstandings. I'm sure that some of the business owners on this call are not that different from our existing clients, and you're experts at your unique business. But there's some common misunderstandings that I see about 25% of the time from business owners. I just want to talk about those as well. What if my financial information is bad? I've got a client right now who historically would do between $20 and $25 million in sales. In the last 18 months with this economy, the nature of their product and service that they provide is one that was materially impacted by this economy. And so his sales went down to just under $10 million in the last 18 months. And he really needs to sell his business. Fortunately, things have started to turn around. He's projecting about a $16 million run rate in sales now. But when we get situations like this, all is not lost. We've had success with what I call hairy deals, businesses that had a better day of glory, and they really need to sell to get either new capital or new resources into it to make it successful. I want to say you never hide it, you never sugarcoat it. Make sure that you lead with it up front, manage the message, identify what the real valid opportunities are with that business, with the business owner and prospective buyers up front, identify what the right solution is, and then go ahead and execute a plan so that you're going to get that solution. Presentation of data and management reports. In addition to your financials, recognize that a buyer wants to understand how it works. You as your business owner know that you have 4 or 5 key levers that you can push or pull that will impact your profitability. You know that if you put an extra $2,000 a month into marketing, you get an 8-to-1 return on that $2,000. We want to be able to understand the different levels that you know and be able to present those as well so that a potential buyer will understand what they can do to grow your business. One other item that's real similar to that is typically a business sale client is 65 years to 80 years old, and they have tremendous opportunities for their business, but over the last 5 to 10 years, they haven't been of the mindset. They're thinking about winding down and selling. They're not thinking about continuing to grow their business. We want to make sure that we're fully exploring those items that a new buyer can do once they own the business that will allow it to fast-track growth again. With regards to formatting information, I get information from a whole variety of accounting firms, from really good ones like John's to not so good ones that are bookkeepers, and they will run a general report off of QuickBooks. Know that we need to present this in a manner that, again, allows buyers to see how easy it is to generate improved performance with your business. Their decision to buy is going to be based on taking your business and improving it. So along those lines, are your cost of goods sold really broken out well so someone can see your gross margin? When we first go to market, we'll typically have a real tight summary financials that only has 4 or 5 lines of items: revenue, cost of goods sold, gross margin, general administrative expenses, then EBITDA and owner add-backs, so they can see the owner add-backs that are going to EBITDA. So we want to keep it really simple in presentation. Do not overload clients right out of the gate with tons and tons of detail. We will need that later. Use graphs if possible, especially if they're helping to support any good trends in your business. With regards to GNA items, this gets back to selling to a strategic buyer or a financial buyer. Oftentimes, if a strategic buyer acquires your company, you will have duplicated expenses. They will recognize it. They will do that analysis themselves. We certainly want to help them along to identify what professional fees, marketing, advertising, legal costs. Is there some of the accounting function? That's usually an area that can be partially assimilated into their function. What are those costs? Let's break those out separately than to the go-forward costs that a financial buyer would have. Remember to add back transaction-related expenses. You will have engaged an intermediary. You engaged an attorney in your accounting firm early on, and you'll likely pay some initial fees for getting your stuff prepared. I want to make sure that those are pulled out as one-time extraordinary expenses as well. A good exercise that I ask my clients to do is get their check register out, start to go through it. It's amazing how much you forgot that you spent that really is an extraordinary item. And it's not that they're all valid, but it's things that sometimes we do want to discuss with prospective buyers to see if they are fully valid going forward. I had a real scenario that happened last Friday. We have a client, and a buyer was in with a 6-person due diligence team, and sure enough, there was a journal entry in their financial information where for over the last 3 years, a large customer had overpaid them to the tune of $288,000. It's about a $6 million a year annual customer. And there was a good paper trail of my client communicating with that customer saying, hey, you've been overpaying for this. We need to get this system squared away. And the customer would say, it's just a little bit. Don't worry about it. We'll get it straightened out. Well, sure enough, there was too much money in the bank, and they had to make an adjustment on their financial statement, and that is $288,000 of non-recurring revenue going forward, which at 4.5 times impacted the valuation on his business about $1.3 million. Working capital. As John noted earlier, this is one of the more contentious areas, but I would ask you to put your common sense hat on, to be the buyer. The principle is this. If I am paying for a certain amount of performance, which is typically either your average over the last couple of years or your trailing 12-month period, then I want to look at the amount of working capital that was needed in the business to generate that level of EBITDA or performance. If you're sitting on a rocket ship right now that's growing really fast and they want to pay you based on the past, then you should convey that amount of working capital. This is my personal belief. If they're going to pay up and pay you for future performance, then you will go ahead and transfer a higher amount of working capital. So that's kind of the common sense approach. We ask someone to address working capital either in a premium valuation or a lesser amount of working capital conveyance if they're really going to be paying based on the past. One other thing that we've seen in the past, some of you are really conservative. You keep huge amounts of cash on your books. A lot of times the working capital definition will include cash. Make sure that you just don't have excess working capital in your business for the sake of it. Identify what the real amount of working capital is that's needed in your business to operate it, to generate the level of earnings that you have been getting a valuation on. With regards to owner discretionary cash flow, again, put your hat of reason on. Be the buyer with regards to discretionary items. I have seen clients come back to me, they throw everything in the kitchen sink, like their cell phones and other stuff. And the reality is whoever buys that business is still going to have a cell phone cost going forward as a cost of the business. Or they're still going to have some transportation-related expenses. So I ask you to be reasonable, recognize that there will be real ongoing expenses that will be perks to the next buyer, but the real expenses of the business. Compare your comp and perks to market, adjust for variances there. Sometimes people will take $400,000 or $500,000 salaries. The market value of that position could be a $200,000 salary, a replacement value. We want to leave that $200,000 in there and not add back the whole thing. We touched about this earlier. Adjustments go both ways. They can either enhance or ding your cash flow. The key, though, when you talk to your accountant and your advisors, you want to make sure that we're able to put a firm stake in the ground to say this is what we really believe is the predictable, reliable future cash flow of this business. This is what we're presenting for sale, and here's the analysis that we've done to get there. Don't forget the season tickets, the personal airplane, the jet fuel, stuff like that. We see the big boats that are entertainment, all kinds of stuff in there. If it's not going forward and a lot of those things don't, then we do want to add those back. Know that going accrual versus cash-based can cut both ways. I've got a client right now where on an accrual-based financial statement, they are much more profitable than their cash-based financial statement. A lot of you on the call right now have given a mandate to your accountants to help you minimize your tax liability. They may be accelerating certain expenses and deferring certain amounts of revenue that are not really GAAP-based, but they are kind of cash financial strategies. Again, it's not out of the ordinary that we could find those kinds of adjustments that can impact your EBITDA by $200,000 to $500,000 in a given year or more, times a 4 or 5 or 6 multiple. You're looking at millions of dollars of value because it's not presented in the most appropriate form. And again, the most appropriate form is going to be that one that really reflects the actual profit-generating capability of your business. One other thing along that area, we've got young business owners as clients with fast-growing companies, and they're profitable, but they're aggressively reinvesting profit into their business, adding more people, and they're not dressing up their business for sale. They don't want to lose momentum for growth. So we want to have, and you want to have a good conversation with your accounting advisors and your intermediary to make sure that if you can break out certain extraordinary growth initiative dollars, that you don't get dinged for that, and that you're really on the fast track of going somewhere. Final thoughts, issues arise. They always arise. I've yet to be on a transaction where something isn't found that you have to address. Our mantra is reiterate to all parties that the objective is to be fair. If you're a buyer, we want you to be fair with our client. If it's our client and they're a seller, we want you to be fair with the buyer. Put your common sense hat on, and normally you'll be good there. Be prepared. I love the concept of the pre-due diligence that John outlined earlier, where you have a full package that's ready to go for prospective buyers that have gotten right down into the nitty-gritty of your financials, so that there's not kind of speed bumps or hiccups in the process, and before you know it, you've got 1 or 2 or 3 week delays in the process, and people start to get weary or tired. Remember also, buyers and their teams are smart. They will find things that you forgot. Be sure to disclose what you can. It's better if you can identify variances and adjustments before they're found by the buyer. Look for stuff. Look for stuff that's out of the ordinary that we can address up front. And then lastly, I'm going to hit on, remember that most large Capex investments are capitalized and depreciated. We see misunderstandings on how that's handled sometimes. Sometimes from a tax standpoint, your accountant may be overly aggressive and they try to expense some stuff that may not be to your advantage. Also, if you run a business like a transportation business with huge amounts of Capex and what we call replacement Capex, then we need to subtract that from your earnings stream, because that really is a real cost. We want to identify what the annual amount of replacement Capex is. In your mind, this is the best way to say it because I see it in clients' minds. We'll go in and they say, man, my accountant says I'm making $5 million. Look at this. And me and my two brothers, we each get $1 million a year. So I think I'm making $8 million. Understand that oftentimes your distributions are not your salary. Your distributions are exactly that, part of the distribution of your profit. Not an exaggeration, 20-25% of the time, that's what we see, a misunderstanding of distributions and how it should be treated, and people want to double add that back. That's not how it works. That's what we have from an intermediary point of view on looking at your numbers.